Who is winning here, the Bulls or the Bears? Let's bring in Greg Branch with Veritas Financial Group. Greg, of course, a CNBC contributor. It's great to have you kick off the hour, Greg. Thanks for being with us.
Carl.
You've been net cautious, right? Your basic belief has been that the market is not accepting what the Fed is trying to convince them in terms of rates.
I think that's right, and I think Waller underscored that today, although you and I discussed he came in a little bit lighter than I thought they would. As we see it, the unemployment scenario hasn't moved in the direction that 425 basis points of raising might think. So we're at 3.5% unemployment. Their target is 4.5%. So I was of the opinion that there'd be another 200 basis points, and they'd probably do 50. Waller indicated 25. He's probably right, and that probably means I'm behind on the 200 basis points as well.
Right. So you think maybe we get, what, 325s, 425s? I mean, what's your terminal rate level at this point?
So I'm going to stay at 6%.
You are?
I'm going to stay at 6%, Carl, and I want to make the distinction between the Fed being wrong and the Fed changing their mind. Right? And so at a time, they were intimating 4% to us. And when the unemployment didn't move the way they wanted it to, and remember that it's the wage growth, right, that is spurred by the tight labor market, and it's the wage growth that then in turn spurs the services inflation. And so when the services inflation isn't moving, when the wage growth isn't moving, it necessitates doing more work on the unemployment. And so when they moved from 4 to 5%, that was obviously because that wasn't, but it still hasn't moved. And so, we're a scant 150 basis points away from 6%, right, and we're still looking at 3.5% unemployment.
And that's on a week where some of the biggest companies in the world are laying off tens of thousands of employees, and a lot of chatter today about job liquidity, right?
Right.
For a long time, if you were an engineer, you could fall back on big tech and maybe get a pretty decent paying job at Alphabet. That option has been locked out at this point. Right. Doesn't that add to slack? Isn't that exactly what the Fed wants?
It does. We have to be very careful about extrapolating results in the tech sector, though. Largely what's happening in tech is that they are right-sizing after the COVID surge in demand. And so that demand surge was off trend. They hired to accommodate those surges, and so they hired well above their organic trend and growth rates. So they're right-sizing. I don't know if it's of the magnitude, even when you combine it with the interest rate sensitive sectors like housing, like auto sales. Even when you combine it with some of those sectors, I'm not certain that it's meaningful enough to put a dent in the 3.5% unemployment number when the banks themselves are expecting about 5% through 2024.
Right. So you do think the labor market breaks maybe a little bit later than people expect. Earnings, you think the market is also behind the curve?
Yeah, and I think these two things are intertwined, Carl. Largely when I came into 2022, I thought that the analyst estimates were magnitudes off. Coming into 2023, I still think that they're too high, expecting single digits in the front half and expecting almost double-digit growth in the back half. If we believe that the impact of the Fed actions are delayed to some degree, I think that's going to start to bleed into that promising back half. Even myself looked at the back half a little bit more optimistically than I did the front half, thinking that much of what the Fed is doing would be behind us. But as we see this delay, as we see this elongated duration between the Fed's actions and what is actually happening in the marketplace, maybe it stretches a while. We saw even in the Fed's beige book that what's happening is companies, although they're seeing a slowdown in their business, aren't letting workers go for fear that they won't find them again.
They're hoarding workers, right?
They're hoarding workers.
Because of what they've had to deal with the past couple of years.
Right.
All right, so let's say the worst case or a bad case scenario is delayed by a couple of quarters. Now we got the debt ceiling and Yellen's comments today about extraordinary measures and T-bills pricing in an X date in June, late June, early July. Right. Is that going to make what might have ordinarily been a net more peaceful Q2 more ominous?
The timing's really important here, Carl. When I looked at 2023 coming into the year, I expected that analyst estimates would right themselves by the middle of the year. I expected that we would no longer be arguing or looking to a Fed to determine our market levels because we'd all have agreement because they'd largely be done. And so when you start to throw in politics, which is what we're doing with this, largely with this debt ceiling, the X date right now is projected to be sometime in the late summer. As we know, the debt ceiling itself wasn't supposed to be reached until that time, and so those calculations can be off. But at the end of the day, I'm hoping that this doesn't slip into what can be a promising back half still. although the estimates are too high, many of the headwinds that I'm concerned about this year and that concerned me all of last year could very well be behind us by the third quarter, by the end of the third quarter, which could set us up for a potentially pretty powerful rally.
Right, but we got some crucibles to get through
yes, we
in
do,
advance.
Sir.